Okay, in this tutorial, I'll be going through with you PYPL, and I'll just copy that, I'll paste it in Google, and I will write stock besides it. And you can see the name of the stock, it's PayPal Holdings Inc. And you can see if I buy it right now, I have to pay 120.26 US dollars, and this market cap is in billions, which means it's a big firm, and there's no dividend yield. Dividend yield is a positive sign if somebody pays, because that means that after paying their loans, creditors, and liabilities, they still have money left, which they give as dividends to shareholders. But this company is not paying any dividends. This does not mean that it's doing bad financially. There are many firms that are doing very good financially, but they choose not to pay dividends. So it's just one factor to consider. And if I look at Wikipedia, I can see a box here, and you can see when was this founded, in 1998, the timing, and which is just 20 years ago. And I just want to copy the real uh, name from Google, and I'll just paste here. I will write in reviews, and I'll search in Indeed. So I want to see what the employees have to say about it. There are like nearly 1100 reviews, and it's 3.9 star, which is very good. It's above average. It's 1100 reviews. You can just read through yourself. I will check the reviews in Glassdoor, and I can see that there are total 1100 reviews, and no, there are 3,300 reviews, which is quite a lot more than Indeed, and it's 3.4 star, which is above average, which is brilliant. And let's look at the I'm interested in key executives, so I'll just search Yahoo Finance, and I want to see um, okay, so make sure that the name matches the symbol we are looking at, and go to profile. Sector is financial services, industry is credit services, and you can see there are 5 executives, but 2 of their salaries have not been shown. Only 3 salaries have been shown. 3 salaries have been shown, so you need to see why the salaries have not been shown. Maybe it's shown somewhere else, because the more information we have, the more transparency. And let's look at Justia Patents, and I'm gonna go to search bar and click enter. I'm interested in assignee and applicants, because these are people who have full rights, and it's PayPal 2014. It has a patent 2014, 2018, 2017, 2010. So it has recent patents in 2017 and 18, which is brilliant. These are recent patents, so it should have recent patents as well, because that means it's still innovating. It still has a competitive edge, and the more patents a company has, the better. And let's have a look at where else we want to have a look. Let's have a look at the macro trend. That's a good website for ratios. I'm clicking to price ratio and price book ratio, and I'll just paste in the symbol. Okay, and I will just paste in the search bar, and I'll click that. And the book value is the real worth, and the stock price is market price. The stock price is $2, and the book value is $1, which means that I'm paying $2 to buy something that is $1 worth. And if the book ratio is less than 1, that means stock is undervalued and at discount. If book ratio is equal to 1, that means that you're not buying an expensive stock, it's the real price. If it's more than 1, that means that you're buying an expensive stock. The higher the value goes, the more expensive it gets. It's right now it's 9.35 times more expensive to buy the stock, but in 2016 it was 3.19 times more expensive. So if you just go up and you see that somebody bought that time in 2016 June, paid $36 to buy something that was only $11 worth, but it was quite expensive. It was three times more expensive, but right now it's nine times more expensive. If somebody buys a stock right now, they will be buying it nine times more expensive. Let's go to other ratios and look at current ratio. If the ratio is less than 1, that means the stock is very risky, and if it's 1, that it's still risky. If it's 1.5 or more than that, that means the stock is not risky, it's very safe to buy. And let's have a look. So it's less than 1.5, it is risky to buy. Let's look at the previous trends. And yes, so in 2016 December it was more than 1.5. And so in 2015 June to September, it was June to December it was 1.5, which was not risky, it was safe. And then after 2016 December it's less than 1.5. So from then on it's again risky stock, it's not a safe stock. Let's look at debt equity ratio. Debt equity ratio should be 0.5 or less than that. This ratio tells if the firm is mainly operating on debt or equity. So we want it to be safe. We are only looking for 0.5 or less than that. Let's have a look. So we don't have any debt information, so it means it might be zero. So which is brilliant. So it's not at all operating on debt, it's only operating on equity, which is brilliant. So it's zero, so that's brilliant. Let's look at return on equity. We are looking for 8% or more than that for it to be really good. Um, right now, the it is more than 8%, and consistently it has been above 8% since 2014 up till now. So which is brilliant because we are looking at 8% or more than that, and it has always been above 8% since 2014, because since then we have data since 5 years, which is very good.